Is May from Markets with May, and today we're going to talk about Netflix, which just finished its earnings call about maybe a half hour ago or so, and it was a crazy good quarter. Like this thing is trading up. It's like if I'm looking at it, I think it's about 50 points in the after. It was like crazy. I think at one point I was looking at it. I have a position on this. I have, oh my God, it's up 8% already. I could kill myself because I honestly did have call options on this, but I had it as a call spread first and foremost. And second, I thought to myself, May, you should really get more calls on this. And I did not. So I have the world's smallest position on this, unfortunately. So I will say that I will obviously just monetize it and move on and see where this thing settles. But this was an exceptional quarter. So let's get into what I saw on the financials. Past performance is not indicative of future returns. Here we go with Netflix. All right, I'm just going to show you my spreadsheet because usually I just basically keep up to date with what's going on, and hopefully you guys can see this really well. But on this, you can see revenues up 12%. Interestingly enough, they did increase marketing expense, which is kind of interesting and not necessarily, here nor there, because I don't think, for whatever reason, I think overseas is really later when we see where the net ads are. That probably is where things benefited quite a bit. General administrative was up. That's just paying people here at year end. Last year was not nearly as good as this year, which you can see from the 15xer that net income was. I mean, that is almost a joke. And that 15x came from a few things. First of all, provision for income taxes. This was a negative. Okay. So there's that. The other thing I want to mention is I have talked about this all last year. All last year, I spoke about the fact that if the Fed increases rates by 5% and you happen to have a bunch of tech companies with a big cash balance, that is the same as giving a massive stimulus to big companies. And so you actually do see it. I'm going to show you exactly where you'd find it. But Netflix definitely had a pretty big cash balance, which even was accentuated by the fact that you had the writer's strike last year, which meant they didn't spend what they might have normally spent as relates to films. And that shows clear as day to the tune of like this ridiculous 500 million, this ridiculous number in interest benefit that you're seeing on the quarter, but also through the year. Okay, so let me show you balance sheet really quick, just a couple of key items: content assets and cash equivalents. So this is like the key thing that I'm talking about. They had about $2 billion more in cash year over year. Part of that is just they hold a lot of really amazing cash assets because that's the nature of their business. Joseph, I know you feel that way. Got a little bit of this. Joseph, I know you feel that way, but I want to show you the numbers regardless because I'm not convinced that this is a BS quarter. This looks probably like what's happening on Netflix. But if you look at this on the spreadsheet, 2 billion more in cash and cash equivalents is crazy high. And realize that right now on your cash, you make 5% just by chilling. And, that's all not normal. And then here, I want to show you with content assets, you do have that number coming in. That's going to be coming in because of, amortization, depreciation of these content assets. And because you had the writer's strike, you just didn't add more in there. But in the fourth quarter, you see an uptick in spending on that. And so we'll talk about that in a second. Deferred revenue. Wow. Okay. This number is why, Joseph, I might feel maybe that it's not possible that this is a lie, because deferred revenue is really going to be people with subscriptions coming in. And then from a function of those subscriptions, basically that's up, significantly. So, check that out as far as that goes. But that is basically why I think that they can give guidance so aggressively. So that's the balance sheet. And now let's go to the cash flow statement. the cash flow statement, I want to point out a couple things. Okay. If you look at, so the cash flow statements are always, they're never, you never get like you really have to look at the previous quarter, which is September, to really understand how the cash flowed through the statement on the quarter. And what I want to show you is here, additions to content assets. If you just look on the year, it looks like they spent 3.5, whatever, as far as that goes. But if you look at just what they spent in the fourth quarter, given that you so yeah, they spent a lot of money on new content creation, but it looks like it's less than last year, except if you realize that you did have some of the writer strike going on. So you can see that's only 16% of last year's number. So you really, the effect of the writer's strike is that right there. Now we know that Netflix sources its content from other places, so some of that is fine, just fine. Stock-based compensation, this one's interesting for it to be down 46%. So they're just paying people in cash, which kind of makes sense given, like I said, how much crazy amount of cash they have on balance sheet. And essentially you have some accrueds. I mean, they just had so much cash that was generated. And they didn't have some of the other weird liabilities that happened last year. So you end up with this ridiculously high cash flow off the quarter. And then when we go to sub ads, it's sometimes a little bit hard to see when you compare year over year. I mean, clearly every single region had higher revenue. You can see that across the period. The only thing that even would be like, oh, let me think about it, would be Asia Pac. But remember, you do have some FX that sometimes goes into where this pricing is. That's the only place where you saw price reduction. Everywhere else, for once, had price increase, even with FX floating in there. And that just hasn't been what it's been for the last year. So this was unambiguously really positive. On top of it, you actually had a lot of subscribers. Like every single region showed a pretty solid, uptick from the previous year. So you're not, and then if you look instead at this, which I prefer to look at, quite frankly, on the summarized numbers, you can kind of see the year-over-year growth in global streaming paid memberships. This is the strategy that they talked about, where they're going to start charging everybody, whatever it is, and then they're going to use the ad version as a way of trying to help those with, more budget sort of concerns. But we're seeing it. It was a solid quarter. The only other things that I would mention that were interesting on the call had to do with how they're thinking about strategy. Now, I was really listening for, hey, so one of the things that came up, and I was really listening for if there's anything that could benefit the theaters, because obviously I do a ton on AMC, and I did not hear anything there. And that is despite the fact that this curiosity is coming up for a lot of people, because they actually had direct-to-consumer movies that are beating from the stuff from the big film companies. So in other words, instead of just, hey, the Netflix movies are somehow inferior to what's shown in the theater, you're actually getting a lot of them coming up for Grammys, a lot of them seeing more viewership on streaming relative to some big production that has done, theater plus later licensing to streaming. And so the question has to arise, for whatever reason, because all the analysts on the street hate AMC, and they're not even thinking, hey, let me actually care about Cinemark and the other two theaters that matter. They didn't ask that question. The only question they asked was, is there any risk to your licensing revenue? What's going on there? Are some companies just refusing to license their movies to you because they're starting to see you as a competitor? Their response was, nah, when it comes down to it, these theaters all need to, or these big production companies need to distribute their film. We're a form of distribution. It is what it is. Some will have whatever response that they're going to have competitively. Others are going to license a different set of films. But the fact is, we have this huge distribution, and so no change there. They did talk about some of their increasing interest in doing live sports. So they have a contract with WWE, which seemed very profitable, but if you're not going to break it out as a line item for me, I'm just thinking of that as a different avenue of content personally. But that's where it stands now. And then there was the world's tiniest conversation on the gaming initiative, since they did start streaming Grand Theft Auto on Netflix via the app. It's an interesting use of assets, to be fair. And they said it's the world's smallest investment right now because it's just kind of a beta test situation. But it'll be something to watch. And I care about gaming for sure, 100%, because I'm a fan of a couple of gaming companies, not the least of which is I have some residual positions in Intel, which owns Mobileye, and then I have some positions as well on Unity. So I'll be watching very closely to see what happens as relates to gaming and the Netflix interface, because that'll be very interesting for what might happen. But we are still in like early days. And as a reminder, we know that Netflix has tried to get gaming working for some time and it just has not worked at all. So there's that. Finally, they also mentioned strategically that they still feel the bulk of what's up is in the core business, which is essentially the film business. And their point is that even though they do have a lot of subscribers, there's still huge amount of hours and eyeballs that they haven't captured. And I actually see this as a change in strategy, despite the fact that they tried to sell it as the same strategy. Their old SaaS strategy was pure subscriber count, right? So this actually voices in a way that pretends like it's always been that way. It has not. But this voices that what they really care about now is hours watched and what that then implies for advertisers. So we are seeing this transition. And like I said, it puts them in competition actually with YouTube, which is the only other streaming oriented service that does specifically that cares more about how long you're watching versus that you're subscribing. That is all I have prepared on Netflix. So I'll keep it short because this earnings season is crazy. If you guys want to write a couple things in the comment, I'll give you shout outs because I love that. Otherwise, if you're catching this little broadcast late, feel free to watch the replay and comment any comments. I definitely respond to comments in my YouTube channel, as well as you can follow me on Twitter, which I'm most active on. I'm a little bit less active in IG, but I do have that, and sometimes people ping me that way. All right, guys, take care. Happy Tuesday.